then we can start the today's session. The last class in the financial institution management, it's called risk management. And the risk management, we have seen some topic, what is risk management and risk management process and various risk classifications, and where we have classified the risk into financial risk and non-financial risk. And the financial risk, we have seen about the financial risk. So today, today's class will be the continuation of the last class. Do you have any questions? Any questions regarding the last class? Okay. If you all have any questions, you can ask from me, or otherwise just send them messages as usual. If you have the any doubt or any comments, any questions, you can send the message through the inbox, so I can able to answer the question. So I can just, if I don't know the answer, I will prepare and let you know in the next class. So having the note, I'm just moving to the next section, the non-financial risk. This is the place where we stop the class. And the non-financial risk, which is the risk of a danger or possibility that can be arise due to the lack of system and procedure, compliance features and misconduct technology and operational challenges and much more. This is also, I think this slide also I will remember, we have discussed this slide as well. And so I needed to much discuss about thing and just refresh the thing and like to move to the next slide. And historically, the bank has always had to manage the financial risk, particularly the credit risk, market risk. However, nowadays bank have also deal with the non-financial risk. As I said that the last class, the conventionally the banks gave more attention on financial risk, where the credit risk, market risk, and liquidity risk. But nowadays it has been that era has been changed, or the trend has been changed, and the banks are giving more prominence to the non-financial risk as well. The non-financial risk, of course, we have discussed already. It is the danger of any possibility of the risk which can arise due to the system, process, compliance, and features. And operation risk, legal risk, strategic risk, reputation risk, regulatory risk are some of the non-financial risk. And I think this slide also I have discussed last class. There are 4 reasons to get the. There are 4 reasons to create an operational risk to the any financial institution. It may be system risk, or it may be process risk, it may be people risk, or it may be external events. And I explained you the system risk, process, and people and external events. If you all have any questions, I can answer you. Otherwise, I think this slide also we have already discussed. We have discussed already. I'm moving to the next risk, the legal risk. Any questions you all wanted to ask from me? Okay, then I'm moving to the legal risk. The legal risk is a part of the operational risk. Earlier, I think sometimes before, this legal risk also has been considered as a part of the operational risk. But after that, after sometimes before, they have the literatures have segregated the legal risk from the operational risk. And the legal risk is a risk of financial or reputation loss that can result from the lack of awareness, misconducting, or reckless indifference to the law and regulations applied to a business, its relationship, process, product, and services. Simply by violating any written law or regulation, especially the written law or the government rules, the legal risk could arise. So that can create 2 types of the losses, mainly the financial risk and other one is reputational loss. The financial losses, of course, because from any of the losses, especially non-financial losses can create 3 types of losses to the institution. It means any of the non-financial risk can create 3 types of losses to the financial institution. First one is financial losses. Of course, if there is any fraud or any violations or anything, the financial loss or any damages may create a financial losses to the particular institution. It may be financial institution or it may be other institution. To the particular institution, operational risk may create financial losses. And second type of losses may be reputational losses. Again, this reputational losses means due to some operational risk, sometimes the reputation of the financial institutions may go down. For example, system failure. Okay, a particular bank's co-banking system getting failure always. So in that scenario, if customers getting know that these particular banks or finance companies, co-banking systems are always getting interrupted and there are slow processes and people are not respected the customers, those type of operational reputation. I think somebody's microphone is on. Can you please keep every microphone in the mute form? Okay. In the reputational loss, of course, when there is any operation risk that creates the reputational losses to the particular bank or finance institution. And third type of loss is business interruptions. Business interruptions, so there's an interruption in the continuity of the business. For example, again we can take the same example, the interruption in the IT system or the co-banking system. When there's in the peak time, if there's an interruption in the IT system, that may lead to a sort of temporary continuation of temporarily, it will harm the continuation of the business process of particular branch or particular operations. So that may lead to a sort of interruption in the business continuation. Same wise, some operational risk could create a huge risk to the bank and finance institution in respect of continuation of the business. For example, if a bank or finance institutions violate the regulatory requirement significantly, that may lead to a situation where the bank or finance institution may not able to continue their businesses. You know that recently, I think a couple of years back, there are some institutions they get involved in the some sort of fraudulent activities and scam. Then the central bank take an action and they suspend the license of particular part of the businesses. So it's created a sort of what I can say, sort of continuation issue. So the same wise, the operational risk could create 3 types of losses to the banks and finance institutions, which is the first one is the financial losses, second one is reputational losses, third one is business continuation losses. So likewise, the legal risk may create 2 types of losses to the finance institution, which is the financial losses, other one is reputational losses. Understand? Okay. Presently, it is considered as a part of the operational risk. One of the primary reasons why the legal risk is associated with the operational risk involves fraud, since it is recognized as a most significant category of the operational risk events and considered to be a legal issue as well. So earlier this has been considered as a part of the operational risk, the legal risk also, but subsequently the legal risk created as the separate type of risk category under the non-financial risk. Okay, then the reputational risk. Of course, the reputation can be considered as a one of the loss as well as one of the risk. The reputation risk referred to the potential for negative publicity and public perception and uncontrollable event to have an adverse impact on a company's reputation, thereby affecting its revenue. Actually, reputational risk should be handled very carefully by the banks and financial institutions. Because when the banks and financial institutions are exposed to the reputational risk, that will have a significant effect to its revenue. For example, this is also in the past papers also there are questions related to this this matter. The financial institution must have more confidence among the customers than the other businesses. Are you agree with this statement? Please explain. This is sort of questions in the past papers. Because considered to the other institutions, the financial institutions should have more reputation and more reliability. Because if we take an example, we are going to a shop, a retail shop or supermarket. When we are buying a good from them, of course, they should have the reputation. But when we are giving the money and we are getting the goods from the particular supermarkets, so there should be a reputation and there should be a sort of reliability, but there need not to be much or significant reliability or reputation. But in case of bank or finance companies, the reputation and trust should be in a higher level. Because we are giving money, we trust on the institution and we are giving money and agree to get back the money after 1 year period. So when we are trying to do that, but what happens is we rely that we genuinely relying that bank and finance institution will have a business even after 1 year period. In that trust only, we are putting the money, we are depositing the money in the banks and financial institutions. So the banks and financial institution reputation must be higher level than the other institutions. Every institution should have the reputation, but the banks and financial institutions should have more reputation than the other type of businesses. So the reputational risk should be carefully managed by the banks and financial institutions. This is very primary requirement. And other thing you have to understand that the reputation can be considered as a risk as well as a losses. Here we are talking about the reputational risk. And there are numerous reasons for reputational risk, including outside adverse events, workplace practices, data retention failures, product recalls, and bad financial statements. The reputations can be depend on several things. For example, if a particular bank's data, the personal customer data got leaked to outsiders, then the bank and finance institution may have more reputational risk. Because the customer feel that my personal information or financial information are going out from the bank, then they will lose the faith on the trust on the bank. So that will create a reputational risk. The customers eventually going out from that particular banks and financial institution, trying to start their relationship with other banks and finance institutions. And other thing you can say, some outside adverse events. For example, if outside hackers, the IT hackers hack the system, that may affect the reputational risk of the particular bank or finance institution. This is outsiders create that that risk to the bank, particular bank. And workplace practices, that of course everybody know, you all may know more than me, since you all are working in the finance institutions, bank and finance companies, you all may have more understanding. Workplace practices will create a reputational risk. For example, if a customer coming to the branch and to deposit the money or to withdraw the money or get the loan, at that time, if the manager and junior staffs quarrel among them, then that will affect the reputation of the particular bank and branch. That will create a reputational risk to the particular banks and finance institution. A negative corporate reputation harms client and investors' trust, erodes your customer base and hinders sales. A poor reputation also correlates with the increased cost for hiring and retention, which degrades operating margin and prevents higher returns. So, reputational risk that will harm the reputation, that will create a reputational loss as well as financial loss. Because when the institution losing the reputation, the operational cost may be high. Simply give an example. For example, if a bank or finance company which have higher reputation, which had a higher reputation, and due to some events, the reputations going down and went down, and after that, after the reputation, when the reputation going down, sometimes good staffs may leave from the banks and finance institution and try to join in some other banks, because the people won't like to work in a unreputed firm, financial companies or bank. If they have the higher reputation, if institutions or bank or finance institution have the reputation risk, definitely the staff turnover of the bank and finance institution will be higher. So to keep the staff, they must pay higher to the particular staffs. So that will create an operational cost. Likewise, there may be several other. For example, if they wanted to keep the customers at the time that they had a reputational risk, they have to give more facilities to the customers. That may create the operational cost to the banks. So that will harm the profitability of the bank. So that will create a financial cost to the banks and finance institutions. I think you all understand the reputational risk. And then regulatory risk, it's a simple thing. We can just easily understand the regulatory risk. The banks and financial institution has to follow some regulations imposed by the or specified by the regulators. In Sri Lanka, who is the regulator of the banks and financial institution, finance companies especially? Who is the regulator of banks and finance companies in Sri Lanka? This is a very simple question, I think. Yeah, of course. The Central Bank of Sri Lanka is the regulator of the banks and finance companies. So regulatory risk is the risk of a change in regulations and law that might affect the industry or the business. Such changes in regulations can make significant changes in the framework of the industry, change in the cost structure, etc. So regulatory risk, for example, the Central Bank of Sri Lanka asking the banks to maintain 20% of liquid asset ratio. So there's a calculation we will study later on. So if a bank failed to maintain the 20% of liquid asset ratio, then bank has to make some penalty to the central bank. Penalty payments. So in that circumstances, particular bank exposed to regulatory risk. Same way, the Central Bank of Sri Lanka require some NPL classification requirement. Or Sri Lanka's accounting body wants to maintain to implement IFRS 9, SLFRS 9 requirements for financial assets. So in that scenario, the particular bank and finance institution has to follow those regulatory requirements. In the so if they fail to do that, then they are exposed, that particular bank and finance institutions exposed to regulatory risk. The finance institution face regulatory risk with respect to capital requirement, NPL classification, liquidity requirement, services and product they are allowed to engage in an implementation of accounting standards. So all these are considered as a part of the regulatory risk and strategic risk, of course. Strategic risk is a risk that failed business decisions or lack thereof may possess the company. So every companies have some sort of strategies and some sort of vision statement and some sort of objectives. When the banks and finance institution or particular business and their business decision fail to achieve their objectives, then that may pose to the strategic risk to the particular bank and finance institution. Strategic risk is often a major fraction of determining a company's worth, particularly observable if the company experiences sharp decline in the short period of time. Due to this, an influence on the compliance risk, it is a leading factor in modern risk management. Since strategic risk comes from the business strategy of a company, it is important for a top management and the board of directors to be involved and create a plan to reduce the risk in this area. So strategic risk also considered as one of the non-financial risks. So far we have studied operational risk, reputational risk, and legal risk, and strategic risk as part of the non-financial risk. So now we have studied three types of financial risk. What are those three types of financial risk? What are those three types of financial risk? We have studied three types of financial risk. What are those three types of financial risk? It is credit risk, market risk, and liquidity risk. So that these three risks can be considered as a financial risk. So what is the non-financial risk? What are the non-financial risks? It is legal operation risk, legal risk, reputational risk, strategic risk, and there are several other risks also can be considered as a non-financial risk. Okay. Then if we summarize this non-financial risk, there are three causes or four causes that could create a risk event. Here it has to be changed as a 4. The 4 causes that could create a risk event, for particularly non-financial risk event: people, procedure, system, and external events, which we have discussed earlier. We are here. System, people, process, and external events can create a operational risk, or at least the operational risk, particularly the non-financial risk. And by these 4 type of causes can create 3 type of losses. This is I have explained to you already. What are the 3 type of losses could arise? Financial losses, reputational losses, fail to achieve the objectives, or business continuity losses. So if there is any questions in the paper asking that what are the 4 causes that could create a risk event, or non-financial risk event, or operational risk event, you have to mention there are 4 type of causes that could create a risk, non-financial risk event or operational risk event. The people, procedure, system, and external event. And and if there is any questions about questions that what are the 3 type of losses that could arise from the risk event, there can be 3 type of losses: financial losses, reputational losses, fail to achieve the objective. Understand? Financial losses, of course, I have already explained to you all. Any type of non-financial losses and operational losses, the financial losses could create it. For example, fraud, the one of type of the operational risk, and regulatory risk. If a bank fail to comply the liquid asset ratio, then they have to pay penalty to the central bank. Or they violate some tax rules, they have to pay this penalty to the income tax department. So they are maybe the financial losses. And reputational losses, of course, I have explained to you very clearly. So that may be one of the losses. And fail to achieve the objective, sometimes it may interrupt the business continuity as well. So there are for any risk event, there are 4 reasons and 3 losses. Understand? Any questions you all wanted to ask me? Otherwise, I can move to the other section, the risk management framework. Any questions you all wanted to ask from me? Okay, then I just move into the risk management framework. In the risk management, this topic, first we have studied what is risk, and then we have studied about what are the risk management processes. Then we have studied about different type of risk management risk. There are different type of risk, where we have studied 2 major category of the risk: financial risk and non-financial risk. Here, as a next section, we are going to move on to the risk management framework. Understand? The risk management framework is the structure process used to identify the potential threat to an organization and to define the strategy for eliminating and minimizing the impact of these risks, as well as the mechanism to effectively monitor and evaluate the strategy. Actually, the risk management framework is the entire process of the risk management. So it's a framework that related to the entire structured process of the entire risk management function. It includes risk governance, risk appetite, risk management process, risk documentation, risk infrastructure, and risk culture of an organization. So here there are several new terms I have introduced here. What is that? The risk governance. Because it says that it includes risk governance. So what is the risk governance? For example, even in the banks and finance institution or any company, there are governance structure. Maybe chairman, board of directors. And under the board of directors, if it is a general company or bank, the general governance structures like this: the board of directors, and again the CEO of the company, and then under the CEO of the company, there may be several other people. DGM, AGM, and senior managers and managers. Likewise, there are governance structure. Even in the risk management framework also, there are separate governance structure for the risk management in the risk management framework. So maybe the risk management board subcommittee for risk management, that may be the top body for in charge to the risk governance framework. And so board subcommittee for the risk management framework, under that chief risk officer, and then under the chief risk officer there may be the several risk officers in different departments. So all these parts include the risk governance of the particular bank or financial institutions. And then second one is risk appetite. What is the meaning of risk appetite? You can see even an individual, some individuals may like to take more risk in their life. But some individuals may not like to take more risk in their life. They are generally risk-averse people. And likewise, for a bank or financial institution also, there are different type of risk appetite level for an institution to institution. Risk appetite, that means the willingness to take the risk level will be different for a banks and financial institution. Different banks and different financial institutions may have different willingness level to take the risk. If a strong bank and aggressive management structure, they are having aggressive management structure, those banks may take more risk. So their risk appetite level may be more. But some banks, they are weak in the capital structure or capital structure, and the board of directors are generally the risk-averse people, and they are in the culture also. They are not taking conventional. They are not taking much risk in their business. So in that bank and finance institution, risk appetite level may be lower. So the risk appetite means the willingness to take the risk level in an operation. That is called risk appetite. Okay, so the risk management framework includes the risk governance and risk appetite and risk management process. Of course, we know that. What is the risk management process? There are 4 steps in the risk management process. I have explained to you. What are the 4 steps in the risk management process? I expect the answer from you. What are the 4 steps in the risk management process? Come on, guys. Please answer. What are the 4 steps in the risk management process? We have discussed in the last class. Yeah, exactly. Identification, analyze, mitigation, and continuously monitor. That is the 4 components of the risk management process. So a risk management framework will include these 4 steps in the risk management. The risk management process. And risk documentation. That is, of course, the documentation process of the risk. There should be a risk policy and risk appetite statement and risk tolerance statements. Likewise, there are documentation that also include. And risk infrastructure. It may be some internal control process and centralized risk management department. Likewise, the risk infrastructure and risk culture of the organization. Actually, this is a separate heading in the risk culture. How can I explain you? Likewise, different banks and different finance institutions may have different type of risk culture. Some banks and finance institutions may have the culture that each and every place we have to follow 100% follow the risk standards. That is the risk culture. Even the top management to bottom management, they may have the culture. Okay, the risk level, we have to comply with the 100%. We are not deviating any risk matters or any risk violating any risk raising matters. Some institutions or some banks may have the less risk. The culture in their risk culture is not comply the 100%. It is depend on the banks and finance institution. The culture may be different, the risk culture. So a risk management framework may include the risk governance, risk appetite, risk management process, risk documentation, risk infrastructure, and risk culture of the organization. The entire component of the risk work, the risk management will be considered as a risk management framework. So the risk management framework can be explained here in this diagram. You can see that risk governance and oversight may be the top. It may be the board of directors or board subcommittee for the risk management. And the second will be the risk appetite statement. The risk appetite statement, as I explained to you all, different banks and finance institutions may have different level of risk appetite. Some banks may have more risk appetite, some banks may have less risk appetite level. For example, I can easily explain to you the risk appetite. If we can take the two banks, Bank A and Bank B, which have the 100 million rupees each, and they are finding the investment opportunity to invest in this 100 million rupees. The Bank A and Bank B, both have the 100 million rupees, and they are trying to invest this 100 million rupee, and they are finding the investment opportunities. So there is an opportunity. It's coming that, okay, they can invest in the X. It will give the 2% return, but sometimes it may create 15 million losses. There is another investment, the investment Y, which will give only 10% return. But losses, there are very rare chance for the losses. So this Bank A and Bank B may have different risk appetite. For example, Bank B has the risk appetite taking higher level of risk. So that Bank B may prefer the investment opportunity of X, where 20% risk, but sometimes there may be 15 billion losses. But if the Bank A's risk appetite level is low, then Bank A will prefer the investment opportunity Y, because even though return is low, there is very rare chance for the losses. So Bank A may prefer the investment Y. So even though there is a same amount of investment, different banks are taking different investment decision based on the risk appetite level of the particular bank and finance institution. That is called the risk appetite. That means the level of taking the risk. So that is the second. When they are deciding the risk management policy or anything, first they have to decide about the risk appetite level of the bank. And after that, I have mentioned the risk management process. The risk management process have the risk identification, measurement, control, monitor, and risk analytical and reporting. Of course, I have said that there are some institutions having 5 steps, but of course, this reporting part we can omit. We can take the first 4: risk identification, measurement, control, and monitoring. And then risk documentation, risk infrastructure, and risk culture. So India components of this risk management is considered as a risk management framework. Now I think you all may have the understanding about the risk management framework. So risk management framework will clear understanding about the particular banks and finance institution risk management. India process. India process means India components of the risk management. Understand? Okay. different institutions have the different risk management frameworks. Okay, even though it's a risk management framework, there are different type of risk management frameworks are there. First one is traditional risk management framework or silo-based risk management framework. The second one is integrated risk management or enterprise risk management. These are two types of risk management framework. The first one is, which is the traditionally followed by the banks and financial institutions. This is called silo-based risk management framework. Under this framework, there will not be a centralized risk management department or a chief risk officer. There won't be any chief risk officer or centralized risk management department under silo-based. Under the silo-based risk management process, each and every divisions of the bank or financial institution will manage their risk at their own. For example, if it is a silo-based risk management framework applied by a particular bank and financial institution, what will happen is the credit risk will be managed by the credit division or credit department of the particular bank. So they will silo basis, they will alone manage the credit risk part, and the cash flow management and treasury management will manage the market risk and treasury risk, the matters relevant to the treasury or cash flow management. And the branch itself or branch management or branch operational division, they will manage the risk arise in the branches at their own. There will not be any centralized risk management process. But under the enterprise risk management process, there will be a centralized risk management framework. The centralized risk management framework means for the risk management in the bank or financial institution, there will be a centralized department for a risk management. And under the centralized department, they are the people will or the risk management people will be responsible for the risk management of entire bank and financial institution, the particular bank and financial institution, entire operations. Even they will have the monitoring on the branch branch operations. They will have the monitoring on what is called treasury management. They will have the monitoring on the risk monitoring on credit risk management. Likewise, the particular centralized risk management department will have mechanism to monitor the entire banks or financial institutions, the risk level, entire branches, entire within the bank, whatever the operations, they will get involved with respect to risk management. So there will be a person called chief risk officer. The chief risk officer will be responsible for the risk management, and the particular centralized department will formulate the risk management policy, and they will formulate the risk management policy. Again, what will happen is they will just monitor whether other department follow the risk management process based on the risk management policy, and time to time they will report it to the risk management board subcommittee for risk management. So the silo-based risk management and enterprise risk management are totally different methods. The silo-based risk management process are managing the risk separately by divisions, separate divisions for their own. But the integrated risk management or enterprise risk management, They are just integrating all the risk operation of the bank or financial institution. They are managing at a central point. So there is an officer called Chief Risk Officer. He is responsible for risk management of the entire bank. So there are two type of risk management framework. If there is any questions like that, what are the two type of risk management process in the short notes or anything, you have to write the silo-based risk management and enterprise risk management. Any questions you wanted to ask? Okay. I hope you are understanding this. And the silo-based risk management, of course, I have already explained. Organizations have traditionally used silo approach to risk management that looks at the individual performance of the business unit instead of more holistic approach that looks at a long-term impact on risk and capital needs of the entire enterprise. So it's separately, they are just, if you keep it the silo-based separately. And enterprise risk management is a new and evolving management risk management discipline that is changing along with the corporate and regulatory landscape of the last decade. Enterprise risk management is the process of planning, organizing, leading, and controlling the activities of the organization in order to minimize the effect of the risk in the organization's capital and earnings. So when they are planning the risk management process, they have to always compare their risk management process with the capital and earnings. For example, any investments, when they are comparing the, when they are calculating the risk, always they will calculate the risk and compare with the capital, the initial investment amount and the earnings. So they will compare with this and they will come to a decision. So what is the relationship between the return, risk and return? What is the relationship between the return and risk and return? What are the relationship? There is an inverse relationship between the risk and return. When there is a high risk, there is a positive correlation between the risk and return. Not inverse, the positive correlation between the risk and return. If there is a high risk, there will be a high return. The low risk, low return. There's a positive correlation. Sorry. And a good indication that company is working at the ERM, enterprise risk management, is the process of chief risk officer or manager designated to coordinate the ERM effort. So under the enterprise risk management process, there will be a chief risk officer or a manager designated to coordinate the ERM effort. Because if it is a large company, large bank and financial institution, they will separately designated a post called chief risk officer. Otherwise, if it is a small company, there will be a manager. He is designated to coordinate the risk of ERM. So these are the two separate risk management framework. Here, of course, we can just identify the ERM, the enterprise risk management, the risk appetite. First, what they have to do is decide the risk appetite level, then risk identification, risk assessment and analysis, risk mitigation. So these are coming as a first risk management, risk appetite, and again risk management process, emergency and preparedness responses, business continuity, process improvement and training, and risk reporting, monitoring, and the risk consciousness and organizational resilience. So all these processes are including the enterprise risk management framework of a bank and finance institution. Any questions before I am moving to the next section? I think you have to be sort of more vigilant on this topic because there are 20 marks question, or there's a 20 marks structural question in the related to the risk management. Okay. Then I am going to move into the other section called 3 lines of defense in risk management. This is also comparably a new concept. 3 lines of defense. And I think one or two times there's a question. There was one or two times there were 2 questions with related to the 3 lines of defense in risk management. The 3 lines of defense in risk management is a sort of concept evolving to the prominent after great global financial crisis, the 2008 and 9 global financial crisis only. Even though these 3 lines of defense concept have been introduced in Asian finance after subsequent to the Asian financial crisis, that was not that much popular before the global financial crisis, 2008 and 9 global financial crisis. Actually, subsequent to the 2008 and 9 global financial crisis, these 3 lines of defense concept evolved or become prominent in the risk management literature. The basic idea for these 3 lines of defense is, there will, for example, if it is a war front, you can see there will be a first line of defense. In front of the enemy, there will be a first line of defense. Some people will be engaged in the first line of defense. And then the second line of defense. If the enemy attack and capture the first line, then second line will defend the war front. I think in some cases third line of defense also there. Likewise, in the risk management also, there will be 3 lines of defense. Even in our body also we can say, for example, if it is from any disease or anything, we will have 3 or 4 lines of defense. First line is clothes. Our clothes will be first line of defense, which will guard us to get infected. Then our skins may be second line of defense. So the inside skins also, there may be third line of defense. Likewise, in the risk management also, there are 3 lines of defense. That is the basic idea of these 3 lines of defense in the risk management. So the functions that own and manage the risk is called first line of defense. The function that oversees the risk is called second line of defense. The functions provide the independent assurance that there's a proper risk management system, that is called third line of defense. Okay, now you will understand. Okay, there are 3 lines of defense: first line, second line, and third line. And some literature says that there are 4th line of defense also. Who is the 4th line? The external auditors may be the 4th line of defense for a risk management process in the bank and financial institutions. If we try to understand this concept, this first line of defense is the management control and internal control system. For example, if we take a bank, the branch management, the branches may be the first line of defense. They are the people own the risk. They are the people face the risk, the branches. And they may have their internal control system. That may be the first line of defense. There will be an internal control measures and there will be a management control measures. That will be the first line of defense. So if there is any risk coming out from the outside, it will hit the internal control system, and internal control system will prevent to enter that risk into the banking operation. That is the first line of defense. And the second line of defense is sort of monitoring system. They may have the surveillance whether this first line of defense is working properly, and if there is any risk, they overcome the first line and enter into the institutions. That is sort of second line of defense. So centralized risk management department or centralized risk management department or compliance department will play the role of second line of defense level. And in the third line of defense, of course, internal auditor will play, the chief internal auditor or internal audit department will play the third line of defense role, which give an assurance that all the internal control measures are in place in the department, in the bank and particular finance institution, so they are enough to mitigate the risk. So they will give sort of assurance to the top management. That's why if you see that the arrow is going to the governing body directly, they will say, okay, there is a separate, there is a strong internal control measures to prevent the risk. So that will be the third line of defense. So in the operation of the bank branch will be the first line of defense. Bank branch or the tellers, bank branch will be the first line of defense, and the centralized risk management department or compliance department will be the second line of defense, and internal auditor will be the third line of defense. And they will give an assurance. These people are monitoring and get involved with the risk management, first line and second line. But third line, they will not get involved in any operations. They will directly report, give an assurance to the top management. The risk management process are in place in the particular bank and finance. They are clearly saying it's an assurance. And out of this, there's a fourth line, the external auditor or regulator. These people are fourth line of defense in the risk management. I think now you will have the understanding about the risk management, the first line and second line, third line of the risk management. Any questions you are having? The first line of defense, the operational managers own and manage the risk. For example, if it is a branch, they are the people own and they are the people manage the risk, and they also responsible for implementing corrective actions to address the process and control deficiencies. Operational management of business unit is responsible for maintaining effective internal control for executing risk and control procedures on day-to-day basis. They are the people manage the risk on the day-to-day purpose. And second line of defense, in the real world, a single line of defense often can prove inadequate. So they say that the first line only cannot adequate to prevent all the risk. So the management established various risk management compliance functions to help and build and monitor the first line of defense. Okay, the second line is monitoring and helping and monitoring whether the first line defense is working properly. So that the second line is mainly they are monitoring and surveillance. So functions of the second line of defense will vary by organization and industry. By type, the typical functions in the second line of defense include a risk management function that facilitates and monitor the implementation of effective risk management practice by operational management and business unit. A compliance function to monitor the various specific risks such as non-compliance and applicable laws and regulations are there. So now you can have the clear understanding. The first line of defense, they are the people that face the risk, they are the people manage the risk, they have some internal control system to manage the risk. But the second line of defense, They are the people, they are just monitoring and facilitating to the first line and monitor whether first line of defense is working properly. So, which is the central risk management department? That is the second line of defense, central risk management or compliance department. Then third line of defense. The internal auditors provide the governing body or senior management with comprehensive assurance based on the highest level of independence and objectivity within the organization. This high level of independence is not available in the second line of defense. Here we have to see, we can segregate this first line, second line and third line based on the independence as well. Compared to these three lines, who will have the more independent? Generally, it is the internal auditor. Internal auditor may have comparably more independent in the particular organization, bank and finance institution. Why? Because he will not get involved with the other functions of the banks. He will not get involved in any operational functions. So he will have the more independent and he will directly report it to the audit subcommittee. So he will have the direct access to the board subcommittee. So more independent person, internal auditor, more independent. And compared to the internal auditor, the risk officer, chief risk officer or risk management function has a less independent, but compared to the first line, they will have the more. But so the first line of defense, branch manager will have the less independent, and the internal auditor, the risk management people have somewhat more independent, and the internal auditor will have more independent. So based on the independency also, the first line, second line and third line will have more independency. And second line will be the middle and first line will have very less independent because they should have the reporting line. Understand? So we can now, I think you all may have the clear understanding about the three lines of defense. The first line of defense, second line of defense, third line of defense. I think this is one of the most important area in the risk management. The first line of defense, second line, third line, as well as the risk management framework, silo-based and enterprise risk management. Do you all have any questions to ask from this area? Because it is better if you all ask, I can clear that at this point. Okay. If you don't have the questions, I'll just move to the next section. Actually, up to this point, I would have finished it at the last class. So I just, due to the timeline and extensively expand my explanation to you all, it track on the time. So now we are moving to the next sections, the credit risk. We have seen already in the credit risk. Credit risk is the financial risk or non-financial risk? Can somebody answer? Whether credit risk is considered as a financial risk or non-financial risk? Financial risk. Yes, exactly. So that we had a sort of very brief explanation on the credit risk. Now we are going to see the credit risk somewhat in very extensive manner. As I mentioned already, the credit risk can be divided into two. First is the default risk. The second one is concentration risk. The default risk, of course, since this has been explained to you all already, I'm just very shortly or very briefly I'm going to explain to you all. It is the chance that companies or individuals will be unable to make the required payment on their debt obligations. The default risk is very simple. If a borrower could not meet their repayment obligations to the bank or finance institution, that will create a default risk. Simply, if a person obtains the loan from the bank and every month he has to pay maybe 200,000, as an installment. But if the particular person failed to make that meet that 200,000 monthly installment, then that will create a default risk. That's a simple understanding of the default risk. The default premium, it is the additional amount a borrower must pay to compensate a lender for assuming a default risk. For example, if a bank grant the loans to the customers, term loans, but bank don't grant at the same rate to everybody. If it is the high conglomerate company, highly rated conglomerate company, they may give the loan at a prime lending rate. It means very low rate. If it is some sort of reputation person, but not that much high, then the bank will offer 1 or 2 basis point, 1 or 2% higher than the prime lending rate. Then if it is a normal customer, individual customers, bank may grant at a higher rate. Why these rate differences are coming? Because the bank adding the default premium to each and every customers. If it is a highly rated conglomerate company, there is a very rare chance for default those loans. So they are willing to grant the loan at the prime lending rate because he is the prime customer. So by the way, what is the prime lending rate? A rate the banks are ready to give to the prime customers is called prime lending rate. So actually average prime lending rate, the central bank is calculating every bank's report average their prime lending rates. So by making an average, this central bank announcing prime lending rate, weighted average prime AWPLR. Average weighted prime lending rate, AWPLR. So if it is a highly rated company, they will give the prime lending rate. So because their default premium is very less. But if it is a somewhat reputed customer, businessman or the customer, then they are just adding some default premium to that particular customer. If it is the individual and he is having the employment in the temporary basis, then the default premium, default chances are high. For that, they are just adding more default premium. For them, the interest rate will be very high. So why that interest rate differences are coming? Based on the default premium. They are adding the default premium to additional amount to borrower must pay, compensate to lender for assuming default risk. How do they calculate the default risk? They are based on their track records and their financial conditions and cash flow. Every banks may have the internal rating system. So based on that internal rating system, they try to assess their assuming default rates or risk, and based on that they are calculating default premium. And estimating default risk, there are way. Normally default risk is calculated by the gross non-NPL ratio. A default risk could be identified through the rating report, track record, cash flow statement, performance of the similar industry. Generally in the central bank or the banking industry, they are calculating NPL ratio, non-performing loans ratio. The NPL ratio is calculated non-performing loans divided by the total loans and advances. Actually, there are in the non-performing loans, there are slight different variations are there. One is the gross NPL ratio, net of IAS, interest in suspense, and net NPL ratio or gross NPL ratio. There are slight variations, but you can have general broad idea that how the default risk is calculated. NPL, non-performing loans divided by the total loans and advances is NPL ratio. For example, if a customer, if a particular bank has the total loan portfolio of 100 million and 5 million rupees they have the non-performing loans, then 5 million divided by the 100 million equal to 5% will be the default risk to the particular bank. And that means NPL ratio of the particular banks. So this is what the default risk is calculated. Understand? Any questions? Okay. Then the concentration risk. This is the last class I have very extensively explained you that what is concentration risk. It is the level of risk in the bank's portfolio arising from the concentration to a single counterparty or sector. I explained you, I will remember, explain you if a particular bank granted to particular customer or 10 customers, some bank having the other bank having the 500 customers, then concentration risk will be high in the bank, the first bank which has the 10 customers. And if the particular bank has the India loan portfolio to the tourism industry and other bank has a diversified industries, then the first bank will have the high concentration risk. It is based on the counterparty or sector. The risk arises from the observation that more concentrated portfolio are less diverse and therefore return on the underlying assets are more correlated. And the concentration risk could be calculated loans and advances to a particular sector divided by total loans and advances. For example, if a particular bank having the total portfolio of the 100 million and 25 million is granted to the agriculture sector, the concentration on the agriculture sector will be 25%. 25 billion million divided by the 100 million. So 25% will be the particular concentration ratio. The concentration risk could be mitigated through diversification. Understand? This NPL ratio could be mitigated through what? Getting collaterals. And then in the credit risk, there is other part. Actually, this is not that much. If it is a multinational banks or financial institution, there will be other risk called country risk. These risks which arises from the sovereign state when it freezes the payment for foreign currency oversight default, so its obligation which is termed as sovereign risk. Country risk is exclusively associated with the performance of the macroeconomic of the country, and it's also closely related to the political stability of the country. You know, the last class also I have mentioned the Sri Lanka's country risk is considered as a high based on the macroeconomic conditions and political risk. Then what they had done is they have downgraded the sovereign rating of the country. Actually, country risk can be measured by the sovereign rating of the particular country. Our sovereign rating has been downgraded by 2 notches from B- to CCC. So the country risk is considered as a high for Sri Lanka, and it is if it is a foreign bank or finance institution granted to the loans and advances to Sri Lanka institutions, then they will consider this country risk. Understand? So these 3 components are available in the credit risk: default risk, concentration risk, and country risk. Of course, the default and concentration is most important, and country risk is only applicable to multinational banks and finance institutions. Any questions you all wanted to ask? And the measures to mitigate the credit risk, there are several measures that carry out the proper credit evaluations. If you want to mitigate the credit risk, you have to carry out the proper credit evaluation. When a bank or finance institution grant a loan, then at that time they have to have proper evaluations and proper internal rating system, and obtain valuable collateral, diversify the portfolio, and making loan loss provision. By doing that, they can mitigate the credit risk. Even if a good customers, but based on the potential risk, they may make some general provisioning for the loans and advances. So these are the 4 methods to mitigate the risk. Carry out the proper credit evaluation. Of course, I need not to explain much because you all may understand. Because when a customer is coming to a bank and finance institution and asking loans, then at that time the bank has to evaluate the customer by getting more information from the customer and their cash flows and their track record, credit report. Based on that, they must have the proper credit evaluation and they have to come up a conclusion that whether this customer is a risky customer or not, and what is the affordable amount for this customer. For example, if a monthly paid officer individual may come and ask the loan for the value which is higher than his monthly salary. At the time, the bank will say that, no, for you, I can give this much of loan, which is affordable to you. So carry out the proper credit evaluation and decide the limits will be one of the mitigating credit risk factor. Other one is obtain valuable collateral. Generally, the banks in Sri Lankan banks are more keen on this. They are getting valuable collateral. If it is a large amount, they are getting valuable collateral. Then if the customer default, they can sell and get it. And diversify the portfolio. That is, of course, for the concentration risk, which we have discussed already. They diversify. Some are for agriculture, some are for tourism, manufacture, individual loans. Likewise, diversify the portfolio. And making loan loss provisions. Even before default event, they can make some general loan loss provision. By doing that, they can keep some cushion. They can create some cushion. If there is any unexpected loss, this cushion will cover that. So these are the methods they can, or one bank or finance institution can mitigate the risk. And actually the loan loss, in the loan loss provisions or mitigation mechanism, there are 2 ratios called provision coverage ratio. The general provision loan loss provision and specific loan loss provision. At the last point I have mentioned, the making a loan loss provision, the banks are doing general loan loss provision and specific loan loss provision based on the central bank requirement. The general loan loss provision means even the customer is default or not, based on the total amount of loans and advances, bank has to make, I think, 0.5 or 1% of the portfolio as a general loan loss provision. And a specific loan loss provision in the sense, if a particular customer defaulted or about to default, based on the particular loan, they make some provision. So this specific loan loss provision is connected to the particular each and every individual loans and advances. But generally, based on the total loan amount, they make very small percentage of amount as a general loan loss provision. So these are the mitigation mechanism for the credit risk. Any questions you all wanted to ask from me? I think I'm just telling you all that whether you all, if you all have any questions, you all can ask. Any questions? Okay. Then the other one is related party transaction. This is, I think, most important thing you all must have much idea. This related party transaction, which is most important aspect in the bank and finance institution. The related party transaction is the transaction that takes place between the 2 parties who hold a pre-existing connections or common interest prior to the transaction. For example, I am the customer. I am going and having the asking the I am having the transaction with the asking the loans, then I don't have any pre-existing connection with that particular bank. But if I am a director, or a director's wife is going and asking the loan from the particular bank, then that particular bank and particular director or his spouse may have a pre-existing connection. Not may have, they have the pre-existing connection, because they are a connection, because the husband is, spouse is a director of the particular bank. That's a connection. Or the major shareholder, they have the, okay, as a shareholder, he has a connection with the bank. So that is to say that the related party transaction is the transaction that takes place between two parties who hold a pre-existing connection or common interest prior to this transaction. Accounting standard define that a related party transaction is a transfer of resources, services, and obligations between related party, regardless of whether a price is charged or not. The related party transaction, why they are very particular about the related party transaction is, when there is a related party transaction, there may be some preferential treatment. The banks may give preferential treatment to the particular related party. For example, I am going and asking a loan from the particular bank, and the director or director's spouse is going and asking, then the bank will try to give more preferential treatment to the particular director's wife. So granting, and so they define the preferential treatment, granting accommodation to related parties at a preferential manner. Because, for example, for for normal customers, if their income is 100,000, they will grant the loan for 5 million. Then, if it is a related party, they may give the preferential treatment. They say, okay, for you all, we can give 7 million. The preferential treatment. Charging lower interest rate for loans and advances. That is also considered as one of the related preferential treatments. For example, if it is the same type of customers, sometimes they may say for the normal customers, the interest rate will be 9%. But then related party, they may say that for you all, we can give the 7%. So low interest, charging low interest for the loans. So preferential treatment. Paying more interest for deposits. If it is a normal customer, general customer, they may say, okay, deposit the money, we will give only 5.5%. But for the related party, we can say that, okay, 6.5% can be offered to you because you are the spouse of the director. Or you are the one of the our major shareholder. That is also considered as a preferential treatment. Providing favorable terms and waive fees and commission. Even they can charge less interest rate, or they can just waive some fees and commissions. For the loan process from other customers, if they charge 25,000 for this related party, they may say, okay, the loan process fees waived. And providing services to related party and obtaining services from related party without proper valuation procedure, that is also considered as a preferential treatment. So in the related party, there are several types of preferential treatments are there. One is granting, one is charging low interest rate or paying more interest rate, providing preferable terms and waive fees, and providing the services to the related party without proper evaluation. All these are considered as a preferential treatment. Actually, they can't do like that. Why they can't do that? Because they are dealing with the public money. So if they give any preferential treatment, that will harm the particular public interest, because they are depositors in interest. So that's what they are saying, that the regulators are very stringent on this related party transactions. So under the credit risk management, this related party transaction should be managed very properly. And disclose requirement for accounting body also says that there should be a disclosure requirement. I think some note they have to say if there is any transaction with a related party, they have to disclose in the annual report. And regulatory limits. CBSL issued guideline on related parties, and SEC also issued code of best practices on related party transaction. Under the corporate governance, we will discuss this related party transaction in very detailed manner. But for you all, under the risk management also has to have some idea about the related party transaction. This is all about the credit risk management. Because in the credit risk management, related party transaction is one of the most important. Okay, do you all wanted to ask any questions? Actually, this is one-way process. I don't know whether you are getting understanding or just listening. I hope you will have more understanding, because I'm just trying to elaborate in a very detailed manner. So I hope that you will have a good understanding. If you all have any comments or anything not clear, please indicate. Then I can just explain to you all in a manner that you can understand. Okay, if we finish the related party, we can move into the liquidity risk, which we have already discussed even at the time when we are discussing the financial risk, where we discuss in very brief manner. Here we are going to discuss in sort of detailed manner. The liquidity risk can be divided into funding risk and market liquidity risk. The funding liquidity risk is the possibility that a bank could become unable to settle obligation with immediacy is called funding liquidity risk. If a bank could not meet their short-term liquidity or unable to settle their obligation in the short term, which is called as a funding liquidity risk. Funding liquidity risk could be managed by banks through maintaining statutory liquidity asset ratio or maintaining maturity gap analysis. I think this is which we have to discuss in very clear manner. In the credit risk, we have seen some mitigation mechanism. Likewise, for the liquidity risk also, there are the mitigation mechanism. One is maintaining some stock of liquid assets. That is one of the mitigation measure. Other one is maintaining maturity mismatches, or maintaining maturity gap analysis and reduce the maturity mismatches. What is maintaining stock? For example, a particular bank obtained the loan for 100 million. Sorry, obtained the deposit from customers for 100 million. Then the bank has the obligation to repay the 100 million to the customers. But only the opportunity that banks will have to repay to the customers in different dates. Because the maturity of the deposit may be some are 3 months, some are 6 months, some are 1 year, some are 5 years. So they can have the different dates. But they have the total obligation to repay to the customers 100 million rupees. So what the central bank is asking from the bank is, or they are required the bank to maintain at least 20% of the liability as a liquid assets. Liquid assets mean the assets which can be easily bring it to the cash flow. So if it is 100 million, then 20% of the liquid, it is called statutory liquid asset ratio, which is 20%. So if it is 100 million liability, what they have to do is they have to maintain 20 million as a liquid asset ratio. It means cash in hand, or treasury bill investments, or treasury bond investment, SLDB investment. Likewise, there are some quickly cashable liquid assets. or deposit with other banks. So they have to maintain a particular stock as a liquid asset form. That is one requirement, the mitigation mechanism. The second one is maturity gap analysis. The maturity gap analysis is the bank may have the inflows and outflows. For example, particular bank for a week, the next week time or next month time, within a 30 days time, the bank has to get the inflow. Bank will get the inflow of 30 million rupees particular week, and bank has to give, or outflow will be 25 million. So in that scenario, bank is a comfortable point because their inflow is higher than the outflow. Inflow is 30 million, outflow is 25 million. It's in the comfortable point. But if it is the other way around, the inflow is 25 million and outflow is 30 million, then bank will have the problem, because in the within next 30 days or the 30 days, bank will have the 30 million outflow and only 20 million inflow. Then 5 million is shortfall. Then bank has to find a way to find that particular the shortage of 5 million to meet the outflow requirement. So they have to maintain the maturity gap analysis. They have to prepare a statement called maturity gap analysis. Based on the maturity gap analysis, they have to mitigate the liquidity risk. So this is one of the way to mitigate the liquidity risk. And SLA are required to bank to maintain the minimum liquid assets to meet their obligation. Nature of the banking business create a maturity mismatch, thus liquid asset. This is you will have to keep in mind. I think there were some questions in the past papers. They asked like this: the nature of the banking business is create a maturity mismatches. Are you agree? Explain that. Because generally in that case, are you agree or not? The nature of the banking business is create or maturity mismatches, or they will ask the nature of the banking business is depend on short-term cash inflow and invest in long-term assets. Are you agree with this? Explain. Are you agree? Yes, because generally the banking business is dealing with the maturity mismatches. You all can easily see the banks and finance companies are collecting the deposit for 6 months to 1 year. The majority of the deposits is less than 1 year period. But they are granting loans for 5 years, 10 years, and likewise the long-term loans, generally 5 years. So there is a maturity mismatch. It's the nature of the business. They have to deal with that. The funding sources are short, but investing sources are high, low. So the bank has to manage with that. So for that purpose, they have to create this maturity mismatch analysis, and they have to always try to find mismatches. So what is the way, if they are finding there's a shortfall, what is the way they will manage the risk? Generally, they will try to go for a whole money market or interbank market. They will use the interbank market. Okay, if there is a shortfall for the next week, what they will do is they will go to the intermoney market or interbank money market, and they will borrow to match that gap. Or if there is a longer period gap, what they will do is they will sell their liquid assets, treasury bill or treasury bond in the government securities market and get that money. So this is the fundamental of the funding liquidity risk in the things. And other thing is market liquidity risk. The market liquidity risk is it is the inability to sell and exit from a particular investment. For example, the bank may own a real estate. Even though they are having the assets, they can't sell that immediately. If they want to sell, it may be fire sale. the prices may be very less. So actually they must have the assets which can be easily cashable without making much losses. So if the market liquidity risk is a risk where they have the assets but they can't sell it at the market. For example, if it is a longer term bond, treasury bonds is a 30 years treasury bonds or 25 years treasury bonds, it is very hard to sell, find the buyer for that treasury bill. Treasury bonds, sorry, it's a treasury bonds. So if it is a 20 years treasury bonds, it's very hard. So at that time, the bank may lose some money when they wanted to immediately convert that into cash. So that type of situation can be considered as a market liquidity risk. The 2008 and 9 crisis are basically created through the market liquidity risk. In the interbank market, in the US interbank market, the bankers are not relied on the each and every county, but they don't rely on the counterparties because there are market that much the market collapsed. So through that, the liquidity issues was popped out. So the market liquidity risk is that. So the liquidity risk can be divided into two. One is funding liquidity risk, other one is market liquidity risk. Funding liquidity risk is sort of the risk of that particular institution or the mistake of the particular institution, but the market liquidity risk will harm the entire market participants. And measure to mitigate the liquidity, maintain minimum liquid assets. That's what I have explained you all, that statutory liquid asset ratio. And improve the cash flow projections. Even though they are preparing the maturity mismatches, they have to improve the projections. For example, the deposits are 1 year maturity, then generally in the contractual form, okay, the customer has the obligation to get the deposit after 1 year period. But in practically, the 5% or 10% of the customers may come before the 1 year. At that time, the cash flow need may arise even before the 1 year. So they have to have a better understanding about that projections. So that's say they improve the cash flow projection. So when they are project the cash flow, they have to factor those things. And perform stress testing to forecast unusable liquidity requirements and contingency funding arrangement. And actually the contingency funding arrangement means sometimes the banks may have the small banks may have the funding arrangement with the other bigger bank. They will have the agreement that if there is any urgent need, you have to give the 100 million or 200 million as a liquid facility. Okay, but they will use only at the urgency. Otherwise, it will keep as a sort of limits. But for that arrangement, the small bank has to give some commission to the or fee to the particular large bank. So this is the contingency funding arrangement. This is also one of the mitigation mechanisms. And maturity mismatch, of course, we know that which we have explained you. And there's other part is the liquidity risk and solvency risk, which we have to. I think there are questions in the liquidity risk and solvency risk. The liquidity risk is now. Have you all understand the liquidity risk first? Okay.
Excuse me, sir. There is a question.
Yeah.
Nowadays, the fixed deposits are very low. That means the rates are.
Yeah.
And someone is saying nearly it's a 5%, right? Nearly maximum.
5%. Yeah.
Someone is saying like foreign banks, so customers has to pay bank for holding deposits in foreign banks.
Okay.
Is the way Sri Lanka also to face in future?
Yeah.
No,
Sorry?
that is in like foreign banks in Sri Lanka also have to face the situation like in Sri Lanka also in future. What about your predictions, sir?
No, I don't think that in the future it will be the negative interest rate. Negative interest rate in the sense in Japan, if we want to keep the deposits, we have to make the payment to the banks. I don't think the Sri Lankan situation won't go to that extent because our government public borrowings are still high. So
Yeah.
when the government wanted to borrow high, that will keep the interest rate in a sort of reasonable level. But currently the interest rates are very low.
Yeah.
So, but I don't think, it's my personal opinion, I don't think it will go to that extent, negative interest rate. But
Yeah.
even if you see that we are entering into the negative real interest rate scenario, our inflation and national inflation is 6%, 6.5%. But 1 year the deposit rate is 5.5%. So we are in the era of negative real interest rate scenario.
And
So
other thing is that customers are normally these days customers are prefer to invest in land or other things. If it continues, there is a liquidity risk in a bank also, right?
yeah, definitely. But the central bank is pumping the ample liquidity to the market.
Yeah.
But of course there will be a deposit. But you know that very strange observation. The last after the this COVID situation, we expected the bank deposit will run out. But it means the bank deposit will decline. But
Yeah.
the actual scenario is the bank deposits are increasing.
Nowadays.
Yes, nowadays increasing in the substantially increasing. Maybe maybe the lot of people lost the job, but some other government sector and some banking sector, the fixed income people, they are earning, but there is no any spending avenue. There is no local tours or unnecessary expenditures and parties and all. So they may have the most savings. That may be one of the reasons having this. Deposits, overall deposit of the banking sectors are increasing. If you see the banking sector data, you can get it. That's a
Okay.
sort of peculiar situation. I don't know. Okay. Uh, so as you say, there may be situation, but it's again based on the monetary system. There may be the central bank will ensure that there will be ample liquidity in the market. Then maturity mismatches, which we have liquidity and solvency. This is one of the questions always coming in the exam. They say that in the short notes also liquidity risk and solvency risk. Or they may answer these are two different concepts. Explain. Actually, the liquidity risk is the risk the bank could not meet their obligation in the short term. It is a kind of short term concept. But the solvency refers to the firm's overall positive net worth or an ability to meet its overall financial obligation. It is related to the long-term financial position. We can simply understand the solvency if a banks and financial institutions net present value of the assets are lesser than are not enough to meet the net present value of the liabilities, then that situation will be the solvency. It means their net present value of the, in the long term, net present value of the assets of the bank is not enough to meet the net present value of the liability in that scenario, which is called solvency. So, but then solvency risk is related to the long-term financial position of the firm. But the liquidity risk, the short-term concept, where the bank would not be able to meet its obligation in a particular short-term period. It is the difference between the measuring the business ability to use its assets to meet its obligation in the short term versus long term. That is the main difference. That it is a short term versus long term, and liquidity is sort of the obligations meet in the short term, but it's a overall long term assets are not enough to meet their liabilities, which is the difference you have to write in the exams, the liquidity risk versus solvency risk. And the other thing is the ALCO, which is also there are questions in the exams. Asset and liability committee, which is responsibility to manage the assets and liability of the banks. In every bank, there's an ALCO committee, Asset and Liability Committee, which manage the assets and liability of the banks. They are the people decide the interest rate for the deposits and loans and advances as well. So ALCO is the decision-making authority responsible for balance sheet planning, the assets and liability management from risk return perspective, and also responsible for strategic management of the interest rate and liquidity risk. This ALCO is deciding the liquidity risk or managing the liquidity risk and deciding the interest rate of the bank. And role of the function of the ALCO to ensure the efficient implementation of the balance sheet management policies, to review the report on liquidity and market risk management, to review the deposit and loan product pricing strategy, to determine the correct assets and liability mix to minimize the profits, to ensure the suitability of funding arrangement for managing maturity mismatches and giving direction to manage interest rate and forex risk. These are very straightforward things. These are the role and functions of the ALCO. If there is actually, I think there were some questions. If they asked the functions of ALCO, you have to simply write these are the functions of ALCO. And the market risk, of course, which is we have already discussed this, and these are comparably, these are, even though it's an important and one of the financial risk, in the literature wise, it does not get that much prominent. There are type of market risk: interest rate, equity risk, currency risk, and commodity risk. The mitigating the market risk is, as usual, diversify the portfolio and using the hedging strategy. I think that these two we have discussed last class as well. So these type of risk arising and mitigation mechanism you have to know. And finally, we are just moving to the risk-based capital. In the risk-based capital, of course, it is a measure to in the capital. There are two type of capitals are required by the central bank for the banks. The first type of capital is the minimum capital requirement. For example, if it is the bank should have, the commercial bank should have 20 billion as a capital. This is minimum capital requirement. But this is not reasonable to ask the minimum capital for each and every banks, because the banking operations may be different. Some large banks may have higher risk and their operations are huge, but very small banks, they may have the operations are very small scale and their risk level also comparably less. At this case, we can't just say that equal capital for every bank. In that scenario, by considering that scenario, the Basel Committee come up with a new ratio called capital adequacy ratio, which require the banks and financial institutions to maintain the capital based on the risk level. What is the based on the risk level mean? For example, if a bank invests in the stock market, 100 million, and the bank B invest that 100 million into the treasury bills. So of course, bank B will have the less risk because they are the treasury bills. But bank A will have more risk because their capital is, the investment in equity is high risk. So they should have the more capital to absorb any unexpected losses arise from the equity investment. So based on that, the idea is, based on the risk level of the banks and financial institutions, different banks may maintain different level of capital requirement, which is measured by the capital adequacy ratio prescribed by the Basel Committee. Actually, earlier the capital Basel 1 came, then Basel 2, now Basel 3 is implemented in central bank. Implemented in Sri Lanka by the central bank. It is the method measuring a minimum amount of capital appropriate for financial institution to support its overall business operation, considering its size and risk profile. Risk-based capital limit the amount of risk of a company can take, and it requires the company to have with a high amount of risk to hold high amount of capital. If, for example, if a bank having the higher risk portfolio, they must keep the higher capital. If the bank have the lower risk portfolio, they must keep the lower capital. And capital provide a cushion to the company against insolvency. So the why the banks are asked to maintain the capital, because if there is any unexpected losses, that will be cushioned by the capital. So I think that's all about the today's class. So we have discussed about the non-financial risk, and then we have discussed about the risk management framework, a silo-based risk management framework and integrated risk management framework. Then we have discussed about the 3 lines of defense under the first line, second line, and third line of defense. And then we have discussed about this financial risk in a detailed manner and related party transaction. And then finally, we are ended up with the risk-based capital, which is based on the risk profile of the bank and finance institution. They have to keep the capital. So if you all have any questions, you all can ask. Otherwise, we can just finish this class. And the next class, of course, I have some balance notes. And if I have the time, I will take through you all the past paper questions as well. Otherwise, the next class, we will see the theory only. The following class, we will go through the past paper questions. If you don't have any questions, I will just wind up this class. Thank you so much.